Okay, it's January 17, 2026. For today's deep dive, we're looking at a pretty remarkable report. It's from an anonymous Nobel Prize-winning quant.
And the central idea is this massive collision,
Right, he calls it the Quantitative winter, which is that big 60-year debt cycle, crashing right into what he calls a technological spring.
which is AI, of course. So you get this huge paradox. You have the deflationary drag of all this debt.
Pulling everything down.
Yes, exactly. And it's fighting against the massive, maybe inflationary productivity boom from AI. The whole report is basically about who wins and who loses in that friction.
So let's get right into the forecast for 2026, starting with AI. The headlines are already, chaotic. You've got Elon Musk suing OpenAI for what, $134 billion?
And at the same time, the EPA is blocking xAI's new Memphis data center. It's messy. And this all ties into what the report calls the slop problem.
Explain that. What is AI slop?
It's not just, bad AI art. It's a technical term. It's low-quality synthetic data that's now flooding the internet. It's poisoning the pools that these models train on.
So the models start training on their own garbage.
Precisely. Which leads to this phenomenon the industry is calling model collapse, a recursive loop of errors.
Which makes sense of the report's scenario B then. It gives it a 60% probability. This isn't a total AI bubble burst.
No, it's a bifurcation, a split. The software companies that rely on those degrading models, they're heading for a huge correction. But the infrastructure layer, that's a different story.
You mean chips, data centers, energy?
The physical stuff. You can't just copy a power plant. Physical scarcity becomes the ultimate hedge. So the report's timeline is, well, a messy Q1 and Q2 dominated by lawsuits.
But it shifts.
It shifts hard into an energy crisis by Q3 and Q4. If you own the power grid, you basically own the AI revolution.
That distinction, software risk versus hardware safety, seems to lead directly into the U.S. market forecast. The report describes the S&P 500 as being trapped.
Trapped is the word, a violent sawtooth pattern, stuck between 7,200 and 7,600.
And the reason is in the bond market.
Yeah, you have to look there. The report specifically warns about a bear steepening. Long-term yields are rising much faster than short-term ones.
Because inflation is coming back.
It's the fear of it, absolutely. And a lot of that is being driven by geopolitics, specifically these new Greenland tariffs.
That's the 10-25% tariff on European NATO allies. It's supposedly retaliation for that purchase dispute.
Right, but the economic fallout for the EU is just brutal. The Analyst is extremely bearish on Europe, German automakers, French luxury.
Uninvestable, basically.
Pretty much, yeah. If Europe is the victim here, the pivot to Asia is really interesting. The report sees China and Hong Kong becoming value plays.
Because they're finding ways around the U.S., like that new Canada-China trade deal.
Capital just flows where it isn't being tariffed to death, but that puts South Korea in a really, really tough spot, the sandwich position.
Squeezed between the U.S. and China. So high volatility for their chips and auto stocks.
For sure. But there is a silver lining for Korea. It goes back to that infrastructure theme, with the U.S. facing its own energy issues.
Korean shipbuilding and power grid companies could boom.
Exactly. But the currency market is where the pain is. The analyst sees a relentlessly strong U.S. dollar, even if the administration doesn't want it. That crushes the Korean won, pushing it into the 4,450 to 450 range.
Wow. And the yen.
A total roller coaster, 130 to 160, just wild swings.
So with stocks stuck and currencies going crazy, the flight to safety part of this report really stood out. And it's not just gold.
Well, gold is in there. The target is $3,200 an ounce, mostly on debanking fears. And oil is holding high, $75 to $95 because of Iran. But the real story is what's called the Bitcoin supercycle.
This was the wildest part for me. It says U.S. states are buying Bitcoin, Texas and New Hampshire.
As strategic reserves, yes, and that completely changes the game. This isn't just retail speculation anymore.
It's state-level hedging.
It's state-level hedging against the federal dollar. The forecast price target is $150,000. It really frames 2026 as this battle between swarm stupidity, political blunders and trade wars, and hard money.
Gold and Bitcoin. It really makes you rethink everything. And I guess that's the thought I want to leave you with. If U.S. states are actively buying Bitcoin to hedge against their own national currency, are we actually watching the denationalization of money begin right here inside America?
That is the trillion-dollar question for 2026.
Thanks for listening to this deep dive. Stay safe out there.